Welcome. Welcome to my channel again. It's possible. Today, what we are doing, we will continue our study. We've been sharing this series on YouTube. Well, we started yesterday actually. So we will be studying. It's gonna be a 4-hour session. So get ready, so we can get this going. All right, everybody, get your notebook, put your phone on Do Not Disturb, get your book, and get ready to be working. Put yourself in a place where there is no noise, it's undistracted, so that we can get going. All right, everybody, thank you very much. I will start working right now. Only dividends paid, not dividends declared, represent the cash outflow. Only dividends paid. Only dividends paid. Only dividends paid, not dividend declared, represent a cash outflow. Only dividends paid. Only dividends paid, not dividends declared, represent a cash outflow. Only dividends paid. Only dividends paid, not dividends declared, represent a cash outflow. Only dividends paid, not dividends declared, represent a cash outflow. Only dividends paid, not dividends declared, represent a cash outflow. Only dividends paid, not dividends declared, represent a cash outflow. Only dividends paid, not dividends declared, represent a cash outflow. Only dividends paid, not dividends declared, represent a cash outflow. Only dividends paid, not dividends declared, represent a cash outflow. Only dividends paid. Only dividends paid, not dividends declared, represent a cash outflow. Only dividends paid, not dividends declared, represent a cash outflow. Got it? Only dividends paid, not dividends declared, represent a cash outflow. Yes.
Yeah, someone's gonna have to take me to school at 1:30 because that's when my AP test.
Okay, tell me. Things to remember. The financing section of the statement of cash flows includes cash inflows and outflows related to issuing and repaying debts, company bonds or equity, issuing company stock, repurchasing treasury stock, paying dividends, dividends paid, not dividends declared, represent a cash outflow. Remember that dividends paid, not dividends declared, represent a cash outflow. So treasury stock, remember what treasury stock is when a company buys back its own stock. They buy it back from um, the shareholders. So when a company buys back their own stock, this is treasury stock. Treasury stock. We have difference between treasury stock and treasury bills. Treasury stock and treasury bills. Okay. Only dividends paid. Only dividends paid, not declared, represent cash outflow. Okay. During the year, very calm purchase $200,000 of ultra bonds at par and 50,000 of U.S. Treasury bills. Verity classified the alpha bonds as available for sale securities and the Treasury bills as cash equivalents. Including statement of cash flows, what amount should you report as net cash used in investing activities? Okay, investing activities. Invest. Long term. When the year vertical purchase $200,000 of ultra bonds Operating activities with understanding investment activities collecting of principal. Proceeds from corporate owned life insurance major repairs, acquisition and disposal of long-term assets, of securities. Okay. But it is classified as available for sale. It's available for sale. Okay. Here the question says that the $200,000 of ultra call. Let's see what it says. Verity classify the ultra bond as available for sale securities in the treasury bills as cash equivalent. Wine it I believe available for sale would be classified as the other comprehensive income. This is a different is this a different concept or are we talking about the same thing here? Same, same available for sale, AFS category, but the question is testing a different concept. You're mixing together how a security affects income. Is the comprehensive income, how buying or selling the security affects the statement of cash flows. Those are two completely different topics. What available for sale means. When a bond is classified as available for sale, AFS, the bond is in investment security. Unrealized gains or losses go to other comprehensive income, not net income. Yes, that is the rule you're remembering. Example, buy bond for $200,000 and of year $210,000. The $10,000 unrealized gain goes to other comprehensive income, accumulated other comprehensive income in equity, not net income. Okay. So your thinking is correct for income statement equity classification, but this question is not asking about other comprehensive income. The question asks how much net cash used in investing activities. How much net cash used in investing activities? Now we are in the statement of cash flows. Different topic. Okay. Statement of cash flows asks, did cash move in or out? So not where gains go, whether OCI, other comprehensive income is involved, whether it affects net income. What happens here? Verity bought $200,000 of ultra bonds available for sale securities, $50,000 treasury bills, cash equivalent. Step 1, available for sale bonds, buy-in investment securities, investing activities. Buy-in investment securities, okay, so it is investing activities. So cash outflow, $200,000, classified as investing activity. Therefore, net cash used in investing activity. Treasury bills are classified as cash equivalent. Cash equivalents are treated almost like cash itself. Moving money from cash into cash equivalents does not count as investing activity on the statement of cash flows. It is basically moving cash from one pocket to another pocket. So the $50,000 is ignored for investing cash flow. Okay. So net cash used in investing activities $200,000. All right. So available for sale. It's not talking about income. It is investing activity. $50,000 treasury bills. The treasury bills is used as treasury or they classify the ultra bond as available for sale securities and the treasury bill as cash equivalents. So when it's cash equivalent, it's not an investment activity. You are just moving money from one pocket to another pocket. Cash equivalent, when it's cash equivalent, is it's not investment activity. You're just moving money from one pocket to another. When it's cash equivalent, it's not an investment activity. You're just moving money from one pocket to another. So the Verily classify the ultra bond as available for sale securities and the treasury bills as cash equivalent. All right. Verily classify the ultra bond as available for sale. Even if you classify a bond as available for sale, it is still investing activity. So here we're not talking about income. So it could be in other comprehensive income. We're talking about investing activities. So even though you classify the bond as available for sale, it is still investing activity. Right now, when you classify something as cash equivalent, it's not investing activity. It is just moving money from one pocket to another. Moving money from one pocket to another. Okay, so gotta take some notes. It's moving money from one pocket to another. Okay. Hmm. So investing activities. Okay. treasury bills are classified as cash equivalents. Cash equivalents are treated almost like cash itself. Moving money from cash into cash equivalents does not count. Okay. Alright, so moving money from cash to cash equivalents. Moving money from cash to cash equivalents. Moving money from cash to cash equivalent is not considered investment activity. Moving money from cash into cash equivalent does not count as an investment activity. Moving money from cash to cash equivalent does not count as investment activity. As an investment activity. It's like moving money from one pocket to another. It's like moving money from one pocket to another. Not having a connection. Oh, please repeat that. Okay. Buying investment securities, investment activity. So cash outflow classified as investment activity. Net cash used investment. So even if you classify um, an investment as available for sale, it is still investment activity. Okay. Cash equivalent. Even if you classify even if you classify an investment as AFS, available for sale, it is still investment activity. Okay. Even if you classify, even if you classify an investment as available for sale, even if you classify an investment as available for sale, it is still investing activity. Now, if you classify an investment as cash equivalents, if you classify an investment as cash equivalents, it is not investing activity because it's just like you moving money from one pocket to another. It is just like you are moving money from one pocket to another. So even if you classify an investment as available for sale, even if you classify an investment as available for sale, it is still an investing activity. Even if you classify an investment as available for sale, even if you classify an investment as available for sale, it is still it is still an investing activity. Even if you classify an investment as available for sale, it is still an investing activity. Okay? So it is still an investing activity. If you classify an investment as cash equivalent, it is not an investing activity. This is what you gotta understand. Okay. All right. Okay. Very cold again. That you with $12,000 in cash and have the following activities to end the year. Depreciation expense 20,000, receipts from sale of rent, tenant assets 50,000, gain on sale of tenant asset 5,300, cash purchase of equipment 75,000. What's the question? What amount should the Berg call report as cash provided used by investing activities in its statement of cash flows for the year? Okay, here we're talking about investing activities still. Depreciation expense. This is not investing, this is operating activity. Proceeds from sale of plant assets. This is investing. Gain on sale of plant assets. This is investing. Cash purchase of equipment. Purchase of equipment is investing activities even if you buy it cash. Net increase in accounts receivable. Net increase in accounts receivable. Accounts receivable, net increase. That's not investing activity, that's operating activity. Decrease in accounts payable. That's not investing. Decrease in inventory. That's not investing. Alright, so let's see. So the question is payment of cash dividend. That's financing activity. Issuance of common stock. That's financing activity. Okay. So what amount should Berg report as cash provided used by investing activities in the statement of cash flow for this year. So, take the calculator and see. Alright, so depreciation expense proceeds from sale of plant $50,000. Gains gain on sale of plant $5,300 plus 5,300. Cash purchase of equipment 75,000. Net increase in accounts receivable. That's not investing activity. Decrease in accounts payable. Decrease in inventory. Okay, so we would say it's $130,000. $130,300. Let's see if that's available. Okay, what amount should be reported as cash provided? Used. Cash provided by investing activities. For cash provided, not cash you spent, but cash you received. Depreciation proceeds from sale of plant. You received money. 50,000. Gain on sale. That's 53,300. Cash purchase of equipment. Used. That's money you paid. That's outflow. Well, it's negative. Because, okay, proceeds from sale of plant. That's money you received. That's cash inflow. Gain on sale of plant. That's also inflow. So you have $53,300 as cash inflow. 53,300 as cash inflow. You have $75,000 as cash outflow. In invested activity minus 55,300. It would be 19,000. So negative $19,700. We are still off. Something is not clicking here. Depreciation expense, not investing. Proceeds from sale of plant, yes. Gain on sale of plant, yes. Cash purchase of equipment, yes. Net increase account receivable, no. Decrease in account payable, no. Decrease in inventory. Net income. Payment of cash dividend. That's financing. Insurance or less financing activity. So explain it to me. If it's negative something, we're off, but I want to know why. 25,000. Okay. 50,000. Alright, so let's see. Investing activities are often viewed as investing in yourself and others. Typical investing activities include making loans to others, purchasing and selling available for sale and held to maturity investments, and purchasing and selling long-term assets, property, plant, and equipment. During the year, the company had two such transactions. The 25, well, what? Proceeds from sale of plant. Gain on sale of plant assets. Gain on sale of plant assets. This is still investment. Why it's not included? not included. Okay, so why the $5,300 on gain on sale of plant assets is not an investing activity? All right, the gain itself is not cash. The sale of the plant asset is investing activity, but the gain is just an accounting calculation. Separate the two things. When the plant asset is sold, two things happen. Cash received, this is investing activity. Here proceeds from sale, $50,000. Yes, proceed proceeds from sale of plant asset, $50,000. Okay, that goes into investing activities. Gain or loss, this is not a cash flow. The gain is simply selling price minus book value. So the $5,300 gain is just, we sold it for more than its carrying value. No separate cash came from the gain itself. Hmm. Suppose book value is $44,700, sold for 50,000. Then 50,000 minus 44,700 is 5,300 gain. Did the company receive $50,000 cash? Yes. An extra separate $5,300 cash? No. Okay, so what does that mean? Proceeds from sale of plant assets, $50,000. Gain on sale of plant. Okay. So why we remove the gain from operating activity under the indirect method? We start with net income, but the income already included the $5,300. All right, the extra cash from the sale belongs in investing, not operating. So if we leave the gain in net income, we would accidentally count part of the sale in operating cash flow. I kind of understand. Okay, gain on sale of plant assets. The gain itself is not an investing activity. The proceed is an investing activity. Investing activity, cash purchase of equipment, $75,000. Proceed from sale, $50,000. Net investing cash flow is 20 minus 25,000. Cash purchase of equipment. Cash purchase of equipment. Okay. 75,000. Proceeds from sale of plant asset. 50,000. So it's negative $25,000. Operating activity adjustment. So okay, let me understand this. Now we're saying that gain on sale of plant asset is not an investing activity. I'm trying to understand this better. Gain on sale. So explain the gain to me again. Gain on sale of plant assets is not an investing activity, but the proceed from the sale of plant asset is an investing activity. Help me understand these two components. Yes, this is exact. Gain is not the cash received. The gain is only the difference between what the asset was sold for and what the asset was worth on the books. Think of it like selling a used car. Suppose your car's book value is $44,700. You sell it for $50,000. You physically receive $50,000. Yes, you do not receive $50,000 cash plus another separate $5,300 gain. Understood? The $5,300 is simply $50,000 minus $44,700, which is 5,300. That difference is called the gain. So there are two layers. Layer one, actual cash movement. This is how much cash came in. That's the 50,000. That is real cash. Therefore, invest in activity because selling long-term assets is investing. It's investing activity. Oof. Okay. It's investing activity. You didn't receive the cash. Okay. Now, if we were talking about operating activity, would that $5,300 be part of operating activity? Because I'm trying to understand the idea behind it. I'm trying to understand the logic that makes this possible. Okay. No, the $5,300 gain is still not operating activity. Even though it appears in net income, it is not considered in operating cash flow. That is the important distinction. Here is the logic. The statement of cash flows separates activities into operating, investing, and financing activity. Okay? Operating activity is normal day-to-day business operations. Yes. Investing activity is buying, selling long-term asset. Yes. Financing activity is borrowing, repaying debt, stock, dividend. Okay. Ask yourself, what caused the $5,300 gain? Did the company sell inventory, provide services, earn normal operating revenue? No. The gain happened because the company sold a long-term plant asset. That is an investing event by nature. Yes. So why does the gain appear in net income? Because GAAP says gains and losses go on the income statement, but net income is not the same thing as operating cash flow. This is the huge concept. Net income contains operating items, non-operating items, non-cash items, gains, losses. Okay, I think we got it. Okay. Okay. So, when we talk about gain on sale of plant, even though it looks to be investing activity, it's not. So that's why it is the $25,000 negative. Which of the following areas does not require disclosure about the risk and uncertainties that exist? Which of the following areas does not require disclosure about the risk and uncertainties that exist? nature of operations, use of estimates and preparation of financial statements, current vulnerability due to possible current vulnerability due to possible recession, current vulnerability concentration, that risk, nature of operation, use of estimates and preparation of financial statements, nature of operation. Nature of operations, current vulnerability due to possible recession, current vulnerability due to concentrations, to risk, use of estimates in preparation of financial statements, uncertainties, estimate. There's uncertainty, nature of operation. What is nature of operation here? Maybe I don't sit down straight. Feel there is a weight on my neck. Nature of operation. What is nature of operation here? Current vulnerability due to a possible recession. I don't understand. Since using current vulnerability to a possible recession is not required disclosure regarding the risk and uncertainties. The nature of operations, the use of estimates and preparedness, financial statements, and current vulnerability due to concentration are all required disclosure accounting to risk. Okay. Hmm. Nature of operation. I don't need what is. Essentially, it's incurred current vulnerability due to possible recession is not a required disclosure regarding risk and uncertainties. The nature of operation, the use of state estimate. Okay, let me. Current vulnerability due to current vulnerability due to a possible recession. See, which of the following areas does not require disclosure about the risk and uncertainties that exist? Oh, current vulnerability due to a possible recession. Current vulnerability due to concentration. Uses of estimate. Okay, alright, let me understand this. Specific risk directly affecting the company, not broad general economic conditions. The required disclosures include nature of operations, company operates only in one country. Company depends heavily on oil prices. Startup with limited history. Disclosure required. Use of estimates. Financial statements use estimates for bad debts, warranties, depreciation, litigation. Disclosure required. Concentration, concentrations, vulnerability. Uh, one major customer, one supplier, one geographic region, foreign currency exposure, disclosure required. Why recession is different. A possible recession affects almost everybody. The overall economy, this is considered a general business risk, not a company specific uncertainty requiring disclosure. Easy memory gap wants disclosure of company specific risk. Okay, so, okay, I see what angle you're coming from. Parker car owns 80% of Smith and Clemens. Parker sells Smith to $150,000 of inventory on the same term as sales made to third parties. Smith sold all of the inventory purchased from Parker in year one. The following information pertains to Smith and Parker cost of goods sold for year one. Parker 400,000. What is Parker's consolidated cost of goods sold for year one? Consolidated cost of goods sold. It's 80% of Smith's income. During year one, Parker sold Smith $250,000 of inventory on the same terms as sales made to third parties. Smith sold all of the inventory purchased from Parker in year one. The following information pertains to Smith and Parker's cost of goods sold for year one. Parker 400,000. Smith 350. Parker's consolidated cost of goods sold. I'm gonna say 400,000. So Smith $250,000 of inventory. I don't understand the idea behind this. You will consolidate. Yes, you will consolidate because you own more than 50%. You own more than 50% of the company. You will consolidate. Now, is there anything else I'm not seeing? Both companies cost of goods sold. Do we eliminate the $250,000 intercompany sale? The answer is we eliminate the sale revenue, we eliminate the purchase, but not from consolidated cost of goods sold if inventory was sold externally. Important consolidation logic. There are two possibilities. Case 1. Inventory is still unsold at year end. Inventory is still unsold at year end. Then unrealized profit remains in ending inventory. Must eliminate profit from inventory consolidated cost of goods sold. Adjusted. Case 2. Inventory sold to outsiders. That is this problem. Then the group has now truly sold inventory externally. The profit is realized at consolidated level. Therefore, consolidated cost of goods sold remains. Why the $250,000 is not subtracted? Because the $250,000 is Parker's sales price to Smith, not the inventory profit amount. And the inventory is already sold externally at the consolidated level. The group legitimately incurred cost of goods sold related to external sales. Inventory remains unsold. Internally, eliminate unrealized profit. If inventory is sold to outsiders, no deferral needed, no cost of goods sold adjustment. The key example here, the sentence Smith sold all inventory to third parties is basically the okay, screaming. No indent inventory issue exists. So here I'm trying to understand the consolidation part of it, right? So the parent company owns 80% of the subsidiary company, right? So it owns 80% of it, more than 50%. So there will be consolidation. Why cost of goods sold is not being consolidated as one? When I say as one, as the parent's company cost of goods sold. Okay. If the parent company owns 80%, why don't we only use the parent's company numbers? But consolidation does not mean ignore the subsidiary. It means treat the parent and subsidiary as one economic entity. That means we combine both companies' accounts together. Think of consolidation like this. Suppose parent Parker, subsidiary Smith. If Parker owns 80%, Parker controls Smith. Yes. GAAP says present them as they are one big company. Okay. So we combine revenue, add together, expenses, add together, assets, you add them, liabilities, cost of goods sold. So why include Smith cost of goods sold? Because Smith operations are part of the consolidated entity. Smith is not ignored. Even though Parker owns only 80%, Parker controls 100% of Smith's operation, yes. So the consolidated statement includes 100% of Smith's revenues, 100% of Smith's expenses, 100%, okay, okay, 750. And we ask where the internal transactions, yes, Parker sold inventory to Smith for $250,000. That is an intercompany transaction. Why intercompany transaction matter? From the consolidated perspective, the parent cannot sell to itself. That's correct. So internally, sales must be eliminated. Okay, but here is the key. Smith sold all inventory externally. Okay, meaning the inventory eventually reached outside customers. The inventory eventually reached outside customers. So from the consolidated viewpoint, a real sale occurred to outsiders. Therefore, the consolidated entity truly has cost of goods sold related to those outside sales. What would happen if inventory remained unsold? Okay, then the part of the profit would still be trapped internally. That would create unrealized profit, and we would reduce ending inventory consolidated income. Okay, okay. Now I see where we're coming from. Combine everything as one company. Remove transaction apparent inside the group because a company cannot earn profit by selling to itself. Makes sense. Keep only transactions with outsiders. That is the ultimate goal. In this problem, the inventory reached outsiders. So after eliminations, the consolidated entity still legitimately incurred total cost of goods sold. Okay, so, all right, so what I'm seeing here is I would ignore the transaction also because it's already one company. It is already one company. And even though Parker sold to Smith, it is considered that there was no movement. We don't even consider that movement. If the products were sold to outsiders, let's say like this, now we have sales. But if no sale occurred outside the company, we didn't have any sale. So we just need to adjust the cost of goods sold. I understand it like that. Let me see. Okay. It is already one company. That is the core consolidation mindset. Okay. From consolidated perspective, Parker's sale adjustment is basically nothing, right? One department moving an inventory to another department. Yeah. No real outside customer exists yet. So initially, no real consolidated sale occurred. Oh, what time is it? So I think it's time for our break. All right, it's time for break. Everybody, it's time for break. So we're gonna go on a break right now. The hour has gone by so fast. So if you're working on something, get your notebook, your book, your whatever you need, so we can study together. All right. So we'll be right back. to work. It was a great break. Everybody has a great break. So we will continue our work right now. So time goes by really fast. Time goes by really fast. If you have any question, you want to ask me a question, you can just put it in the comment section, and then after we're done, I will answer your question. Oh. All right, so we are back. We are back from break. I was talking to myself probably. If you have a question, you can just put it in the comment section, and then I will answer after we're done with the live stream. So the reason we're doing that is to motivate you to to study yourself, to find something that you like, to add some credentials behind your name, right? So take your time. It's only 3, sometimes 4 hours a day, but if you can do 3 hours a day of study, this is amazing, right? So let's do it, okay? So I'm not inviting you to come and see me work. I'm inviting you for you to work, to use this as a motivation to work on whatever you want to work on, okay? So let's get it going. All right, enough talking. value consolidated profit. Okay, because the inventory stayed inside the consolidated entity. Only thing consolidation cares about is did the inventory leave the consolidated group. Inventory stays inside supposed by the seller. Parker sells to Smith. Smith still has the inventory at year end, and from consolidated perspective, the inventory never left the company. Okay? The sales are not real. Profit is not real. Part of cost of goods sold must be adjusted because the profit is unrealized internally. Okay, as no consolidated sale exists, profit sales for okay. Smith sold all of the inventory. So let's say that Smith did not sell all of the inventory purchased from Parker in year one. Let's say it sold 50% of the inventory. How would we adjust cost of goods sold? Original information, Parker sold inventory to Smith for $150,000. Suppose Smith sold under 50% of stone. The other 50% remains in Indian inventory. That means $250,000 and $125,000 remains inside the consolidated group. Key question: what portion of that 125 contains internal profit? Because from consolidated viewpoint, that inventory has not truly been sold yet. Meaning the profit portion is very important. We do not eliminate the entire remaining inventory. We eliminate only the unrealized profit embedded inside it. Suppose that originally cost the inventory $200,000 and sold it to Smith for $250,000. So Parker made $50,000 profit. Profit percentage 20%. So the inventory transferred internally contains 20% unrealized profit. And sold inventory remaining, Smith still has 125 of the transferred inventory. That inventory includes unrealized profit of $25,000. What does consolidated do? Because inventory is still inside the consolidated entity. The $25,000 profit is not real yet. So we eliminated consolidation adjustment. We reduce ending inventory by 25,000 because inventory is overstated and consolidated net income by 25,000 because unrealized profit was recognized internally. Flexing cost of goods sold. This is the important part. To reduce consolidated income, we increase consolidated cost of goods sold by 25,000. Why? Because increasing cost of goods sold reduces profit. Kind of logic right there. Good dream. Okay. Okay. 400, 500, 750. Well, the answer is 500,000. How can you explain that? Mm, not inventory adjustment entry. Combine both cost of goods sold, 750. Eliminate entry 250 from the consolidated viewpoint. Parker cannot sell inventory to itself. That intercompany transaction must be eliminated. Now here's the important part. Smith 350 cost of it include purchase from Parker. But Parker also already include that inventory cost inside its own cost of goods sold. So if we simply add both companies, okay, consolidated cost of goods of 500,000. All right. Okay. Inventory purchase included. Inventory sales of inventory eliminated. Inventory sold included. Okay. 750, so you move to 250, and that's 500,000. Okay. The following expenses were among those incurred by Sire Company during year one, accounting and legal fees, interest, loss, and sale of office equipment, rent office space, 1/4 of the rented premises is occupied by the sales department. How much of the expenses listed above should be included in Cyrus general administrative expense for year one? Legal fees, interest, loss and sale office, loss and sale of the office and equipment and property rent for office space, $200,000. 1/4 of the rented premises occupied by the sales department. All the expenses listed above should be included in general and administrative expense for year one. General and administrative. Accounting and legal fees. It's not general interest. It's not general loss and sale of office 25,000. Rent for office space 200,000. Office space 200,000. General and administrative expense. License 225. 300. Okay. What? I don't know. Dirty like this. Right. That's correct. This answer is correct. The accounting and legal fees 160 and a portion of office rent not allocable to sales. And 50 are all considered general and administrative expense. Therefore, general and administrative expense should be 310. 160 plus 150,000. One quarter of the rented premise is occupied by sales department. How much? What belongs in general and administrative? One quarter of the rented premise is occupied by the sales department. That means part of rent selling expense, part of rent administrative expense. Core classification idea selling expense. Costs related to marketing, sales staff, sales desk, sales office, advertising. General administrative expense, costs related to corporate office, accounting, HR, executive management. The rent allocation, total office rent 200,000, sales department occupied 25%, so sales expense portion is 50,000. That part is not general and administrative. Remaining rent equals general and 50. Okay, then they combine it with other administrative expense. 310. And you see office cost. Who used the space? Department classification. Sales department selling expense. Executive admin office. General and administration. Factory manufacturing overhead. Yeah, easy. Selling, getting customers. G&A running the company, manufacturing, making the products. So okay, who uses the space? When you see office cost, ask who uses the space. If sales department use it, is selling expense. Executive admin, general and administration, factory manufacturing overhead. Okay. Belongs in general. And for every product and selling expense, product and administrative expense for classification. Selling expense costs related to marketing, sales workers. General administration expense, corporate office. I understand this. General administration. Who uses this space? Let me see office cost. Admin office. Admin, selling expense. General. General administration, sales department, selling expense, factory, manufacturing overhead. Who uses this space? So if it is okay. If a company uses the indirect method to report its statement of cash flows, how would the amortization of bond premium be presented? If a company uses the indirect method to report its statement of cash flows, how would the amortization of bond premium be presented? Cash inflow from financing activities, cash outflow from financing activities. If a company uses the indirect method to report its statement of cash flow, how would the amortization of bond premium be presented? Amortization of bond premium, amortized bond premium, cash flow from financing activities, bond premium, financing activities, intermittent control, whatever cash flow from operating activities, reduction from net income to whatever cash flow from financing activities, application of bond premium, the presented as net cash flow, activation additional to net income, addition to net income to whatever cash flows from operating activities, addition to net income, whatever from operating activities. Cash flow from operating activities and direct method net income, non-cash expenses and non-operating items that decreased net income, amortization, depreciation, cash flow from operating activities, net income, non-cash expense, and non-operating items that decreased net income, amortization expense, decreased net income with bond discount, losses from sales of assets, depreciation, non-cash revenue, and non-operating items that increase net income, equity earnings from investees, amortization of debt premium, gains from sales of assets, changes in current assets and current liabilities, increases in current assets, operating activities. Section of the statement of cash flows includes cash flow related to the production of income. Yes, this section is commonly prepared using the indirect method, which reconciles net income to the net cash flows from operation. One category of reconciling adjustment is non-cash item amortization. The amortization of premium Bonds payable is a non-cash item that reduces interest expense and consequently increases net income. Therefore, the bond premium amortization must be deducted from net income to reverse its effect. Conversely, the amortization of a discount on bonds payable as well as other non-cash expenses such as depreciation decreases net income and would be added back to net income in the reconciliation trace. Maybe this can the operating activity. The operating activities section of the statement of cash flow. The amortization bond premium represented how it the operating activities section of the statement of cash flows. The operating activities activity section of the statement of cash flow. The statement of cash flows includes cash flows related related to the production of income. Production of income. This section is commonly prepared using the indirect method. This section is commonly prepared using the indirect method. Huh? Oh, okay. Alright. This section is commonly prepared third years and section is kind of different using the indirect method. Method which reconcile net income. Design net income to net cash flows. Design net income to net cash flows from operations. One category of reconciling adjustment is non-cash items. Means amortization. One category of reconciling adjustments. Reconciling adjustments. Is non-cash items. So the amortization. Amortization of the premium on bonds payable is a non-cash item that reduces interest expense. The amortization of the premium on bonds payable is a non-cash item. is a non-cash item that reduces interest expense. Reduces interest. It reduces interest expense. And consequently, increases net income. Consequently increases net income. Therefore, the bond premium amortization must be deducted from net income. Therefore, the bond premium amortization bond premium amortization must be deducted from net income. Amortization premium on bonds payable is a non-cash item that reduces interest expense and consequently increases net income. Therefore, the bond premium amortization must be deducted from net income to reverse its effect. To reverse its effect. Conversely, the amortization of a discount on bond payable decreases net income will be added back. The amortization of a discount on bond payable, as well as other non-cash expenses such as depreciation, decreases net income and will be added back to net income in the reconciliation. Okay, I'm gonna leave it like this. This right here. Alright, so if a company uses the indirect method to report its statement of cash flows, how would the amortization of bond premium be presented? Deduction from net income to arrive at cash flows from operating activities. Deduction from net income. deduction from net income to arrive at cash flows from operating activities. So we'll come back. In which of the following cases is the subsidiary most likely to be reported as an unconsolidated subsidiary? Unconsolidated. The subsidiary is in an industry unrelated to the parent? No. Subsidiary has a fiscal year, and that is 1 month different from the parent's year end. Subsidiary is in legal bankruptcy. The subsidiary has a controlling interest in another entity. Wow. Okay. Ooh. Okay. Subsidiary is in legal bankruptcy. Okay, when will a subsidiary not be consolidated? Normal rule, less than 50%, yes, but the subsidiary is consolidated, ownership and control. Usually these things do not stop consolidation. Different industry, different year, and subsidiary on another company. Why bankruptcy matters? Consolidating requires control. If the subsidiary is in legal bankruptcy, the parent may no longer truly control operations. The bankruptcy court or trustee may now control the company, so consolidation may no longer be appropriate. Analyze each choice differently. Okay. If it's in legal bankruptcy, there cannot be consolidation. In which the subsidiary is in legal bankruptcy. In which of the following cases is a subsidiary most likely to be reported as an unconsolidated subsidiary? And the subsidiary most likely be reported as unconsolidated subsidiary. The subsidiary will be reported as unconsolidated if it is in legal bankruptcy. I'm gonna write this down. That's really important. There you go. A subsidiary will most likely be reported as unconsolidated. Okay. A subsidiary will most likely be reported as unconsolidated and consolidated if the subsidiary is in legal bankruptcy. If it is in legal bankruptcy. Bankruptcy. So be reported as unconsolidated if it is in legal bankruptcy. Okay. Williams Inc. Williams Inc. acquired land and building as a lump sum purchase. In such transactions, the purchase price will be allocated to each individual asset. However, the entire purchase amount was incorrectly debited to the land account, and as a result, no depreciation was recorded for the building in the first year. Williams discovered the error prior to closing the books. Correcting the error will result in what? Result in what? instance acquired land and building as a lump sum purchase. In such transactions, the purchase price should be allocated to each individual asset. However, the entire purchase amount was incorrectly debited to the land account, and as a result, no depreciation was recorded for the building in the first year. Okay, so the entire purchase amount was incorrectly debited to the land account. As a result, so if you want to correcting the error will result in what? Net income will decrease. Total asset. What would it entail to correct the error? Correcting the error will okay, so in such transaction the purchase should be acquired land and building as a lump sum purchase. Land and building. So land goes to land, building goes to building. But he puts everything in the land account. So the entire purchase amount was incorrectly debited to the land account. Okay. As a result, no depreciation was recorded for the building in the first year. No depreciation. Now, when you do the depreciation, what's going to happen? Net income will increase. Total asset will decrease. You still have the asset. Let me check that. Insert it. Okay, yeah. Still have the asset, my friend. What happened originally? Okay. Williams bought land and building as a lump sum purchase, but they made a mistake. They recorded everything as land. And there is no depreciation for land because the land cannot be depreciated. Why is this wrong? Because land is not depreciated. Yes, building is depreciated. Okay. What mistake does this create? Since everything went into land, no depreciation expense was recorded. That means expenses were too low. Net income was too high. When recorrecting the error, the company must move part of the amount from land building, record depreciation expense on building. Yes. What's the effect? Recording depreciation increases expense, therefore net income decreases. Ooh. If you record depreciation, you increase expense, net income decreases. Effect on total asset. Depreciation creates accumulated depreciation, which reduces buildings' carrying value. So total asset will decrease. So you have an increase in expense and a decrease in asset. A decrease in net income decrease in net income, decrease in asset. Decrease in net income, decrease in asset. Income decrease, expense increase. If you increase your expenses, you decrease your income. And asset decrease. So recording depreciation will increase your expenses. You need to understand that. Increasing reporting depreciation increase your expense. It decreases your income and your asset. Okay? Reporting depreciation. Let me try to understand this. Reallocating of cost from a land account to the building account is a reclassifying entry and does not impact net income or total asset. However, recording depreciation expense will decrease net income. The recognition of accumulated depreciation, a contra asset account, will decrease total asset. Yeah. I understand that, but what I'm trying to understand, okay, I had the impression that if you report your record depreciation, it would increase your net income. That's what I was thinking. Why would I think something like that? Because I'm thinking that once you report you report the depreciation, that will increase your money. That's money coming back to you. Help me understand that. It's a confusion. I'm getting value back from the asset. That's what I think. But accounting treats depreciation very differently. The key idea, depreciation is an expense allocation, not cash coming in. Depreciation is an expense allocation, not cash coming in. What depreciation really means, suppose a company buys equipment for $100,000, okay? The company already spent the cash when it bought the equipment, okay? Cash already left. The purchase entry, all right, the purchase entry at purchase, debit equipment $100,000, credit 100,000. So cash goes down, equipment goes up. No expense yet. Then depreciation happens. Suppose the equipment lasts 10 years. Accounting says don't expense the whole thing immediately. Instead, spread the cost over the useful life, okay, of the equipment. So each year, 100,000 divided by 10 is $10,000 depreciation expense. Depreciation entry, debit depreciation expense 10,000, credit accumulated depreciation 10,000. No cash enters, no money comes back. What depreciation actually does, it says part of the asset's usefulness was consumed this year. That is why expense increases, net income decreases. Statement of cash flows, indirect method. There we do this. Net income plus depreciation. People see depreciation being added back and think, oh, depreciation increases income. But that is not what is happening. Why depreciation is added back in cash flows? Because depreciation reduced net income, but no cash was actually paid this year. The cash was paid earlier when the asset was purchased. So in operating cash flow, we reverse the non-cash expense. Bear in mind. Okay. I don't want to be confused with this. You report depreciation, it decreases your net income, it decreases your asset. It's fair enough. It's fair enough. It's a lot of things that they confused me. Fair enough. So, report depreciation. You will decrease your income, decrease your asset, increase your expense. You can just write it down. Okay. Prior change, can I with that? Depreciation. As a result, no depreciation was recorded. Okay. So recording depreciation depreciation current depreciation decrease your net increase your expense increase expenses decrease net income and decrease assets. Okay, that's fair enough. Okay, that's good. All right, so it's gonna be time for our next break. So about 30 seconds. Let's go ahead and take the break. Then we'll be back in 10 more minutes. Okay. 10 minutes. All right, it's time for break. Okay. So, We are back. We are back from break. It was a great break, and time goes by so fast as you study. So, yeah, let's get back to work. Um, if you can do that every day, you can take 3 hours to study every day. Check to see how many hours it's going to be in 1 year. So, we do that 5 days a week. This will really help you to master anything that you're working on. At first, it's going to feel um, as if you're not doing anything. But the first week, second, after the first month, you will really feel that you're learning something. So go ahead and register. If you want to go back to school, register at school. If you want to take a license, whatever you're studying for, just go ahead and do it. We're going to be here every day, every morning, 7 o'clock. We'll be here around that time. Things may change, but we'll be around that time available to guide this study session. It's a 3 hour, it's about 3 hour and a half of studying. So go ahead and let's start doing it. All right, let's get back to work. All right, so we are back. We are back from break. It was a great break. Imagine if you can do that every day for 1 year. That will really make a difference in your life. If you can study for 3 hours every day, 5 hours a week. That will definitely make a difference in your life. You can master anything that you want to master. Studying 3 hours a day. So let's go ahead and let's go back to work. Okay, so we're gonna be here every day from Monday through Friday. We're gonna be here around 7 o'clock in the morning. 7 to 10, 10:30 to 11 most likely. So this is our schedule. All right, let's get back to work. Equity. Equity equity. Shareholders equity. Common stock. 75,000. Investment debt securities. 75,000 is not that. Common stock. Following information is obtained from Smith Service September 30th each. Plus year to date 2004. Beginning inventory 30,000. Ending inventory of September 30th 13,000. Smith historical gross margin is 1,000. What is the amount of the year to date purchases? Year-to-date purchases. Sales year-to-date. Beginning inventory. Ending inventory September 30th. What is the amount of the year-to-date purchases? Year-to-date purchases. Sales for year 275. Sales beginning inventory. Ending inventory. So you have sales, you have beginning inventory, you have ending inventory. Since historical gross margin is 20%, what is the amount of the year-to-date purchases? Historical gross margin. 30% what is the amount of year-to-date purchases? I think it. session is testing your understanding of gross margin and inventory flow. Unit different purchases. Understand gross margin, historical gross margin 20%. That means gross profit is 20% of sales. So it's like 275,000 times 20% is 55,000. Gross profit is $55,000. Current cost of goods sold. Sales minus gross profit 220,000. Use inventory equation. Beginning inventory plus purchases minus ending inventory. Yes, beginning inventory plus purchases minus ending inventory. Okay. Beginning inventory minus purchases plus ending inventory. And beginning inventory plus purchase minus ending inventory. P beginning inventory minus purchase. Beginning inventory plus purchase is minus using inventory equation. When they give you sales, they give you gross margin, immediately find gross profit. Find cost of goods sold, then use beginning inventory plus purchases minus ending inventory is cost of goods sold. I'm looking for what is the amount year-to-date purchases. I have sales, I have gross margin, and gross profit. It's 20%. Historical gross margin is 20%. Gross profit. Gross margin, before you do all that, and then do this instead. Short information. Beginning inventory plus net purchases minus cost of goods sold minus cost of goods available for sale. Minus ending inventory cost of goods sold. Let's use this. I have to come back to this. It makes sense. Gross profit method is typically used to estimate ending inventory based on the relationship between sales of goods sold and gross profit. However, also be used to sell for cost of goods sold. One, Presley Co. has provided the following year's current account balances for the preparation of the annual statement of cash flows. Accounts receivable 11,500. December 31st, 14,500. Allowance for credit losses 400. December 31st, 500. Presley's huge net income is 75,000. Net cash provided by operating activities in the statement of cash flows should be net cash provided by operating activities. Operating activities in the statement of cash flows. Net cash provided by operating activities account receivable. Operating activity cash was year 2 net income 75,000. Got it. Okay. Year 2. January 1st, December 31st. Providing the following year 2. Okay. Account receivable 11,500. Present year 2 net income. Net income is 75,000. Net cash provided by operating activities. Payment expense. Account receivable 14,000. Allowance for credit losses 500. Prepayment expense 4,000. Account payable 11,000. So you already have 75,000 net income. So you have this information. Account receivable operating. Allowance for credit losses. I should also be operating. Triple rent expense. Account payable. January 1st, December 31st. Recruitment expense. Okay. Account payable. Okay. This is indirect method statement of cash flow problem. We start with net income $75,000, then adjust for working capital changes. Accounts receivable increased from 11,000 to 14,000, just 3,000. We're gonna add this, increase in, subtract from CFO. Allowance for credit losses. That's 100. This represents bad debt expense. Bad debt expense reduces net income but in non-cash. So add back 100. Step 3, prepaid rent expense. Prepaid rent decreases 2,100. Decrease in prepaid asset means expense recognized exceeded cash paid, meaning the company used up prepaid rent instead of paying new cash. That increases operating cash flow. Alright, 2,000. This is, you still have $2,000 left. Step 4, accounts payable increase from 11,000, from 9,700 to $11,200. That's 1,500. Step 5, adjustment. Net adjustments 700. Final 75 for $775,700. Okay. So calculating the difference is 3,000 plus account receivable increase, 3,000 plus allowance for credit loss increase, that's plus $100. Okay. That's 3,100. Prepaid rent, that's 200. 6,200. That's $2,100. Accounts payable increased. Alright, let me do this to see. $3,000 plus 100. Prepaid rent expense 2,100 plus 2,100. 4,000. Minus would be $2,700. So yeah, 72,000. $75,700. Subtract. Okay. Accounts receivable. Okay. accounts receivable increased. Accounts receivable increased. So you have less cash coming in. So minus 3,000. Allowance for credit 100. Why do we subtract the $3,000 when accounts receivable increased? I thought it would be an increase in cash or not a subtraction. Accounts receivable, money. But accounts receivable is not cash, it is money customers still owe you. What an increase in account receivable really means. Suppose last year account receivable was $11,500. This year it's $14,500. The increase in account receivable is $3,000. That means the company recorded more sales that have not yet been collected in cash. Think about the journal entry. When a company makes a credit sale, accounts receivable, credit revenue, cash is received, but net income increased because revenue increased. Okay. Bill Inc. had the following information available at the end of usually accounts payable decrease. Also decrease in accounts payable. Accumulated depreciation increase. Available for sale debt securities decrease. Inventory increase. Net income rose. Income was $790,000. The available for sale debt securities were sold for $135,000. Equipment was sold for $350,000. They had a cost of $600,000 and accumulated depreciation of $250,000. There were no other transactions involving these accounts. In bills with real statement of cash flow, net cash provided by operating activities was operating activities. Net income was account payable decrease 5,000. Accumulated depreciation increase 50,000. Increase. Available for sale debt securities decrease 100,000. Inventory increase 80,000. Net cash provided by operating activities. Net income was 790,000. Sold. Efficiently sold. That had a cost of 600,000 and accumulated depreciation of 250,000. There were no other transactions involved in these accounts. So I have 135 plus. Accounts payable decrease. If accounts payable decrease, that's money you will not be paying. Accumulated depreciation increase. Accumulated depreciation increase. Depreciation increase. When you increase depreciation, it decreases your net income. It decreases your inventory, your asset. Available for sale debt securities decrease 100,000. Inventory increase 80,000. So here I'm gonna say minus 5,000. Account payable decrease 5,000 plus 5,000. Accumulated depreciation increase. Increase depreciation. Available for sale decrease 100,000. Inventory increase inventory. Help me complete this. It's gonna be a piece of cake for you. Net cash provided by operating activities, CFO. Cash provided by operating activities. Using indirect methods, start with net income 790,000. Step 1, account payable decrease 5,000. Accounts payable decrease $5,000. Decrease in current liability. So subtract 5,000. Decrease in current liabilities, subtract 5,000. Inventory increase. Inventory increase in current asset, subtract 80,000. Step 3, depreciation. Accumulated depreciation increase. Depreciation is non-cash, add back. Add back 50,000. Step 4, ignore available for sale securities decrease. This is investing activity. So do not include in operating cash flow. The $100,000 decrease in irrelevant for CF is irrelevant for CFO. Step 5, equipment sale gain or loss. Equipment sold for 350, original cost 600,000, accumulated depreciation 250,000. Okay, so 350, 250. That's 600,000 anyway. Calculate book value. 600,000 minus 250, 350. Book value equals selling price. Therefore, gain and loss is 0. So no CFO adjustment needed. Basic compute CFR 790,000 adjustment plus 50,000 minus 5,000 minus 80,000 is negative 35,000. 755. Gotta understand this concept. I get it. I did that already. 7. Another. Seven. The securities is for myself. Ooh. The cash inflow of 135 is reported under investment activities. $35,000 gain including net income less fee deducted. Okay. The answer is 970,000. $970,000. Okay. 790. Depreciation 50,000 plus. This represents depreciation expense, non-cash. 790,000 plus 50,000, 840,000. Step 3, accounts payable decreased by $5,000. Decrease in current liability. Subtract from CFO. 35. Inventory increased. Inventory increased. $80,000 increase in current assets. That's minus 80,000. Here's the big trap. The question says available for sale debt securities decreased by 100,000 and securities were sold for $135,000 with no other transactions. That means the securities had the carrying value of 100,000 but were sold for 135. So there was a $35,000 gain. Gain increased net income, but gains from sale of investment are investing activities, not operating activities. So under the indirect method, subtract the gain from CFO. I don't know, you know what we're talking about here. Sometimes ChatGPT doesn't even know what it's saying. Yeah. Mm-hmm. Diploma on that page of consolidation 7% on subsidiary has $50,000 in interest payable to its parent. The amount that should be eliminated is on the date of consolidation. A 70% owned subsidiary has $50,000 in interest payable to its parent. The amount that should be eliminated is everything. 50,000. Parent acquired its interest in Spring on January 2nd, year 1. Early year 1 price sold goods to Spring at the same method. Spring has not paid for all of the paid since July 27. What was the amount of intercompany sales from? Accounts receivable. Alright, Spring consolidated 39,000. That's the question is, let's just see what else. What amount of intercompany sales from card to spend during year 1? Intercompany sales. What was the amount of intercompany sales from card and spend during year 1? Account receivable, inventory, and control and interest, calculated revenue, cost of goods sold, gross profit, net income, income statement account, balance sheet account, okay. Inventory, card debit, consolidated 52. say that I should going to be corrected to 32,000. In a business combination, the process of consolidation results in a single set of financial statement that treats the parent and subsidiary as a single entity. For a financial statement consolidation process, an entity can engage in business transactions with itself. Elimination entries are made to remove the effect of intercompany transactions. Roll Inc. owns 80% of Cowen Co's outstanding capital stock. On November 1st, Roll advanced 100,000 in cash to Cowen. What amount should be reported related to the administration concerning Roll Inc. owns 80%. November 1st, Roll advanced 100,000 in cash to Cowen. What amount should be reported related to the administration concerning on July 1st, year 2, fully issued common stock for an additional 75,750 of Cyber's outstanding common stock. Sample continues to make sustained sales. We would together how much of Cyber's used to net income should be reported as financial statement. Cyber's net income 25%. Read it again. September 1st, year 1. Select Inc. issued common stock in exchange for 20% of Cyber. Okay? So 20% of Cyber on outstanding common stock on July 1st. Year 2 for issued common stock for an additional 75% of Cyber's outstanding common stock. In exchange for 20% of Cyber. 20% of Cyber. Okay? Now outstanding common stock. July was initially issued common stock for an additional 75% of Cyber's outstanding common stock. So now you have 75, 35, you have 95%. Cyber continues in its consensus for the subsidiary. How much of Cyber's year 2 net income should be reported as equivalent to Philips? 20% of Cyber's net income to June 30th, and all of Cyber's net income from July 1st to December 31st. To June 30th, and 95% of Cyber's say A because July, yeah, makes sense. It's 95% of my why 95%? Hmm. Well, there is a 5% non-controlling interest, but you own more than 50%. Okay. The equity method is used to account for investments when the investor can exercise significant control over the investee greater than 20% ownership. The investor recognizes its share of investee net income based on its ownership percentage. When that percentage changes, the share of net income is adjusted going forward. Well, the equity method is used to account for investment when the investor can exercise significant control. Mm. So this is different from consolidation. Different from consolidation. It is different from consolidation because I know that if a company owns more than 50% of another company, um, it eliminates or it would account for all of the gain, not part of it. Consolidation reporting and income attributable to the parent. These are related but not the same thing. Okay. Income attributable to the parent. These are related but not the same thing. That is exactly why this feels confusing. Timeline of ownership from January 1st to June 30th, year 2, Philip owns 20%. That means significant influence, equity method, not consolidation. So Philip recognizes 20% of Cyber's income during this period. Then on July 1st, year 2, Phillips buys another 75%, which makes it 95%. I understand. Now Phillips controls Sago from July 1st onward. Consolidation begins. Here is the key concept. Even under consolidation, the parent does not own 100%. Phillips owns 95%. not 100%. Okay, so the remaining 5%, I know there is a remaining 5% belongs to non-controlling interest. This is the part causing, that cause some confusion because I know if you own greater than 50% of another company, you account for all the loss and all the gain. Unconsolidated statement, yes, we report 100% of subsidiaries' revenues and expenses, okay? But then we split net income between portion. What net income? This is what hmm. All right, we'll get it. Don't worry about it. We're gonna get it. When a full set of general purpose financial statement are presented, comprehensive income should be and a full set of general purpose financial statements are presented. Comprehensive income payments and balances should be that income should be reported in that calculated income tax individually after a supplemental schedule in the notes. The percentage of income is not comprehensive income or net income or loss plus minus items of other comprehensive income possibly including whole period and minimum pension liability adjustment in unrealized gain or loss on a derivative posterior debt investment, a foreign currency translation adjustment, and gain loss on a hedge. The effective portion of cash flow hedges. The percentage as part of the income separate financial statements following the income statement. Translation loss component of comprehensive income. Translation loss. Recorded as a component of comprehensive income. Translation loss recorded as a component of income. Recorded as a component of comprehensive. Translation loss recorded as a component of comprehensive income. Component of comprehensive income. That's the mistake. It's called the comprehensive income. Okay. Translation loss recorded as a component of income and continuing operations. Bentley, there is a dark red. Oh, she's not too far. It's a dark red forward edge. You ready? Okay. Well, she's gonna. Let me see. When the hell's. Oh, she's outside. She's waiting. All right. When the hell's arrived? Well, our next session is almost done. I'm done with the work I was doing, so we have 3 minutes left. We have 3 minutes left to complete the last session. So officially, we have been working here for 4 hours. All right, so we started at 7. Now it's 11. So that's a 4 hour work session, which is pretty good. Well, that's my second YouTube video on Study With Me. That means I don't have anyone watching right now, but maybe you may be watching this at a later time. That's good if you're watching this some other time. But as of right now, my second video, so I had no one watching. That's fine. That's okay. I'm doing this mostly for myself, for my discipline, so that I can stay disciplined to do the work that I have to do. Okay, and if someone finds it beneficial, that's a great benefit. That's a great thing. So hopefully you'll be watching this video sometime in the future when I'm already completed everything. All right, I will come back and watch this video too. But if not, maybe you're watching this 2 days after. That's good. But I want you to work on something, right? So get yourself registered. If you've been thinking about going back to school, go ahead and register and go back to school. If there is a license that you have to take, maybe you're studying for your series license as an insurance professional, go ahead and get registered, right? Register and start studying. So we set the schedule at 7 o'clock every day. We'll be here. Sometimes things may change, but we will maybe announce to myself because there ain't nobody watching right now. So, but we will announce it if we're not going to be exactly at 7 o'clock. But this is our schedule. 7 o'clock every day from Monday through Friday. We'll be here studying and mastering, right? Because this is what it is. That moment where no one sees you. This is the most important moment, right? The moment where no one sees you. The moment you're locked in, you're doing the work. This is precious moment, right? The stage is one thing. The applause is another thing. You know what I'm saying? But the moment where nobody's applauding you, the moment where no one sees you, the moment where you are in a dark place, you're doing the work. This is the most important moment. All right, this is the most important moment. So I want you to take your notebook, put this in your calendar, in your schedule, so that we can meet every day, so that we can work on something. So I'm telling you, you can see I'm working on a lot of things right now, so that we can get these completed. All right. So our time is up, ladies and gentlemen. Thank you so much for sticking around. Nobody. All right, but hey, I see two people watching. Maybe myself and somebody else. My wife. Maybe my wife is watching, or I don't know who. But leave a comment if you're watching here right now. Leave a comment. Maybe when I become a millionaire, I will come back and see who left the first comment and send them a gift. You know what I'm saying? So just go ahead and leave a comment. If you're watching this right now at this hour, as I am live, write a comment so I know you're here. But after that, it's until tomorrow. I will see you again tomorrow, God willing. All right? The day has not ended yet. So keep being productive. Keep working on yourself. Keep working on your goals and your dreams, because it will pay off. All right, everybody. Thank you very much. God bless. Have a great day.